be an opportunity to answer any questions at the end. So to start off with, I'll give you a brief overview of the global market and a few of the key highlights of each region, and then I'll go on to talk about a few more of the, I think, more interesting details, more specific to specifically the US and North America. Firstly, I'm going to give you a brief introduction to Hays. So Hays is a leading global staffing and recruiting company. We're publicly traded on the London Stock Exchange. This year we had revenues in excess of $5.3 billion US. We work across a multitude of industries, including oil and gas, and we focus on helping our clients find the best professionals to hire full-time or the best contracts and temps for non-permanent positions, and our candidates the best jobs in the market. We focus mostly on white-collar professionals in engineering, IT, finance, accounting, construction, and then scientific and project functional areas. In addition, we're a managed services provider. Clients outsource their recruitment processes and their temp and contractor management to us, and we provide technology platforms that make these processes more efficient and effective. We have about 8,200 staff in 33 countries around the world. Last year we placed more than 57,000 people into permanent roles and more than 212,000 temporary and contract assignments around the world. We do the salary guide every year in conjunction with one of the leading oil and gas job boards called oilandgasjobsearch.com, and it's jointly created with them. They're one of the industry's leading job sites. Their database contains over 1 million industry professionals, and it's a great source of candidates, and I highly recommend you visit their website if you haven't done so far. To give you a quick background to the actual survey, 6 years ago we started publishing the guide specifically for the oil and gas industry because we found that there wasn't really a source of compensation information or hiring trends, global hiring trends available. That was at the same time sort of broad in its reach and also sort of detailed in functional disciplines and provided information in the context of local hiring and labour markets. So our aim is to provide our clients and job seekers with the information regarding the trends and the compensation benefits, particularly as they vary from country to country. Given the global nature of our business and the fact that almost a third of workers work outside their country of origin, we believe that our guide is a useful resource for both companies and job seekers alike. This year we had a record number of respondents, just over 45,000, who represent a strong cross-section of the industry, from super majors and IOCs to smaller operators, from service companies and to EPCs to equipment manufacturers across 188 countries. It covers 25 disciplines, ranging from reservoir engineering to geosciences and petroleum engineering, construction, subsea, project controls, health and safety, so on and so forth, at a wide variety of levels. Just to look at the demographics of the actual respondents. So I think one of the things that was of most significance for us this year was that we noticed a large increase in the number of women responding to the survey. Whilst it's too early to draw any meaningful conclusions from this data, we will look at this more specifically in a minute for the North America region, but it'll be interesting to monitor the data over the coming years to see how global campaigns to attract more women to the industry are having an effect. Although there's only a slight about a third of the workforce that responded are working internationally, and then about 35% of the respondents this year were actually contractors, and we've seen a 3.6% increase year on year in the number of contractors in the market. So firstly, just coming on to have a bit of a global overview of the market. We're going to go on a bit of a trot around the regions in a second, but firstly to give you a general overview. I think it's important to point out that since we completed the survey in approximately October, the price of oil has fallen to the lowest level in the last 5 years, and the unforeseen decline will not have been fully reflected in the survey, although we will see later on that people weren't completely bullish about the 2015. This is indicated in the high level of confidence in the market exhibited by respondents. 2014 has been a bit of a roller coaster. We started the year with mild concern in certain regions regarding the health of the industry, and that's really grown into nervousness across the globe. Given the geopolitical and economical turmoil, demand for oil has been weak or weaker, and this is coupled with surging production from shale oil in the US and a rebounded production in Libya and Iraq, which has left the markets fairly awash with oil, and consequently we've seen the oil price drop by more than 50% since their highs in June of 2014. Needless to say, the industry state of affairs has been impacted, and the price decline will continue to impact the labour market. The survey indicates that global salaries have bounced back from 2013, where there was a slight dip, after taking into account the changes in demographics, after taking into account the changes in demographics of the respondents of the survey and the fluctuations in currency exchanges. All that translates into about a 1.3 increase in salaries around the world. There are still hiring hotspots, but we've also clearly seen a slowdown in the pace of hiring, with capex budgets for 2015 typically being between 20 and 25% lower than last year. We've also started to see layoffs in a small number of high-profile companies around the world, and we expect further consolidation in operating and service companies, which will weaken the global job market a little bit. For those of us that have been in the industry for a while, these events are neither new or surprising. Economic growth leads to increased energy demand, which leads to price increases. That attracts capital, which then leads to increased activity and hiring, which can lead to supply outstripping demand, as we really find what's going on today. Unfortunately, this is often the case during the downside. The reverse occurs, which remains to be seen how steep the decline in activity is going to be. But I think 2015 is certainly set to be an interesting year. We're just going to move on through the regions and do a bit of an overview of each of the regions. So in North America, the US continues to become a dominant oil producer globally. It's left other producing nations, most notably OPEC, figuring out what to do to absorb the output. Advancements in technology has seen production in the US soar by over 3 million barrels per day since 2011, exceeding 8 million barrels this year, largely due to surging production from unconventional sources in shale, where production reached a 28-year high, and US imports fell from 45% in 2011 to 26% this year. While the ban on exporting crude is unlikely to lift in the short term, light oil exports have been sanctioned, and North American gas developers are eager to export LNG. Companies have applied for permits to total more than 380 million cubic meters per year, which is roughly the equivalent to all the world's current liquefaction capacity. In 2015, drilling activity is set to decline, basically because of the unattractive economic returns in some of the areas of both emerging and mature oil production regions. Many companies have begun redirecting investment away from marginal exploration and research drilling and focusing on core areas of major tight oil plays. Oil prices currently remain high enough to support some development drilling activity in 2015 in the major shale plays, albeit considerably lower than previously forecast. Companies that have lower drilling and debt costs and have acreage in the sweet spots of these regions will continue to drill highly productive wells in 2015. Nevertheless, with projected WTI crude oil prices starting to rise in the second half of 2015, drilling activity is expected to increase again as companies take advantage of lower costs for both leasing acreage and drilling services, causing production to resume and hiring. Could this produce a vicious circle of events? In Canada, activity this year initially saw a rebound on the strength of the oil price. However, with recent events, operators are starting to slow down, to postpone activity in the higher cost oil sand plays. I think it's important to note that the Canadian market has been pretty flat for the couple of years, largely due to the issue over transmission The much talked about Keystone Pipeline is still stuck with policymakers in Washington, as so are a couple of the other pipeline projects stuck with various bodies in Canada. So whilst it's unlikely there's going to be any increase in oil production in Canada, there are a number of LNG projects that are getting pushed through at the moment. There's 18 underway, and it looks like at least 2 or 3 of those are going to push through into development over the coming year. Moving on to Latin and South America, they're experiencing increased interest as changes in legislation and expectations of strong economic growth will potentially create opportunities for investment. In Mexico, in order to reverse its decade-long decline in production, aims to attract as much as $50 billion in foreign capital by 2018, as well as the talent it lacks to develop its deep water and unconventional reserves. Its round one auction is due to be held in the autumn of 2015, although with the current oil price, this looks likely to be postponed. Although if the auction does go ahead, it will see over 150 onshore and offshore blocks auctioned off. Argentina, like Mexico, has also moved towards a more open market and has started to overhaul its energy regulations and approve its incentives to lure foreign investors. The country is cash-strapped, but its shale reserves could make it energy self-sufficient for decades if it can attract the capital and skills it currently lacks. It's still too early to know whether these reforms in Mexico and Argentina will take root. Mexico will have to counter its deeply entrenched nationalism and make difficult decisions on how to implement its policies, whilst Argentina must win back the confidence of the international companies it spooked around 2 years ago when it expropriated Repsol's stake in YPF. Brazil is reconsidering its policies implemented in 2010. Investors have been losing interest in this market due to its energy policies, raising costs, reducing efficiency, and increasing business risk. In addition, the government decision to halt a decade of annual auctions in 2008 is being questioned. Brazil enjoyed rapid expansion of its production and considerable international interest when it had a predictable auction schedule, but since 2009, growth has stagnated. Finally, the government-mandated local workforce content requirements have caused the country's construction and service companies to struggle to maintain service quality and keep costs under control. Brazil still dominates the subsea segment of South America, and it's expected that as much as $90 billion will be spent on subsea projects through to 2020. While the government's forecast is for production to double by 2023, it may struggle to find the capital and skills to meet these aggressive goals. To address its skills shortage, the government has launched a series of efforts to attract expat Brazilians back home and to accelerate training of new workers, with limited results so far. And finally, on Venezuela, PDVSA is struggling with its post-Chavez nationalistic policies. The cash-starved state-owned company may be forced to sell further international assets, for instance, Citgo, in order to raise cash and to potentially prevent asset seizures by international companies seeking compensation for nationalized assets. Venezuela is currently petitioning OPEC to cut production and help its ailing economy. Looking at Europe, now that Scottish independence has been decided, that I, for one, was happy to see that result. One element of uncertainty has been lifted and should benefit industry activity. However, little's changed in terms of the ageing assets in the UK North Sea, and most companies have adopted a decidedly wait-and-see attitude before they make further investments, as they await implementation of the recommendations from the Wood Review. Since peak production in 2009, output has steadily declined due to complex geology, poor exploration success, difficulty increasing recovery from existing fields, and unattractive commerciality. The latest activity levels imply a dramatic reduction in near-term activity, as Deloitte research indicates it is almost 5 times more expensive to produce a barrel of oil today than it was in the late 1990s. However, new tax breaks for brownfield projects could spur increased interest if we see an upturn in the price per barrel. In the UK continental shelf still has significant potential to unlock additional reserves if geologic, technical, and commercial challenges can be overcome. North Sea oil companies made their lowest profits in 5 years during the first quarter of 2014, and companies on both sides of the North Sea are cutting investment programs, focusing on cash flow and preparing for potential turbulent times ahead. Investments in Norway are expected to drop for the last, to drop at least 30% this year, based on $50 per barrel prices. Seismic companies have seen their markets soften as the appetite for exploratory investments has diminished, and offshore drillers have witnessed rig rates fall sharply as companies have cut capital spending. For onshore UK and Europe, the jury is still out on whether unconventional drilling picks up steam. In the UK, new legislation is making it easier for companies to drill horizontally under residential dwellings. However, there is significant opposition within the country for that to happen. And due to the slowing nature of the market and the increasing costs associated with the production, particularly in the North Sea, operators and EPCs are seeking to streamline their operations by replacing contractors with permanent staff where possible. There's plenty of procurement-led initiatives going on as well to drive down contractor day rates and consolidate suppliers are also being put into greater effect. Moving on to Russia and the CIS. So Russia relies on oil and gas-related duties and taxes, and the political tensions between Russia and the Ukraine have been partially responsible for the current global economic uncertainties. And the US and EU sanctions against Russia are resulting in delayed and cancelled trade, which has affected Arctic and shale projects worth billions of dollars. The combination of sanctions and the oil price decline has seen the value of the Russian ruble plummet, and in turn affected profits of the Russian companies. For example, Gazprom saw its profits hit by as much as 40%. And then moving on to the Middle East. The Middle East region is really split, with Saudi Arabia, Kuwait and the UAE experiencing continued investment both in greenfield and brownfield projects. There are conflicting reports as the break-even point for Middle Eastern oil plays, with reports claiming anything from $18 per barrel to $40 per barrel. Saudi Arabia, the leading member of OPEC, has continued stated that it will not cut production in order to bolster oil prices, and is happy to allow market forces to dictate the price. However, they are coming under increased pressure from other OPEC members that rely more heavily on revenues from oil production. Iraq continues to be destabilized by continued militant activities. However, importantly, these disruptions have yet to impact Iraq's southerly oil fields. There's a continued and real risk that militant activities will spread to parts of the region and could create major disruptions in the production and transport of crude and associated products. Currently, there's more than $234 billion worth of engineering and procurement and construction contracts that have been awarded on oil, gas and petrochemical schemes in the Middle East region's energy sector, exhibiting an unprecedented surge in project activity in the past few years. Looking at Africa quickly, Africa is expected to hold a 15% share of offshore capital expenditure over 2015, which is up 10%, and is led by developments in offshore Angola. In West Africa, offshore Ghana and Congo will also see increasing expenditure. Total's giant, the Egina development offshore Nigeria, is anticipated to be the single most capital-intensive project offshore West Africa over 2015, acting to drive down Angola's leading, albeit still dominant, share in the region. According to an International Energy Agency special report published in late 2014, almost 30% of global oil and gas discoveries made over the last 5 years were in sub-Saharan Africa, which reflects a growing global appetite for African resources. Deep water skills are still heavily in demand there, mainly reservoir and drilling engineering, but increasingly gas experience, especially LNG liquefaction process engineering, naval and subsea engineering, after significant gas fires in Mozambique and Tanzania, are also on the increase. Moving on to Asia, Singapore has grown to be a significant energy hub, and energy now accounts for about 5% of the country's GDP. With Singapore's first LNG terminal now fully operational and entering into phase 3 expansion. We're waiting to see if Singapore's government will push through on its stated intention to position Singapore as a hub for LNG activities in the region and targeting LNG bunkering operations by 2015. There are still some regulatory hurdles for the state to iron out before bunkering operations commence, but we've seen companies tracking progress in this area with a view to market entry. However, this is still in early planning stages. A more traditional stronghold for the Singapore market has been the expertise and proven track record in the design and construction of offshore production facilities, including rigs, FPSOs, FSOs, and topsides. Singapore is responsible for 75% of the world's FPSOs currently under construction, which is a huge number. In China, activity levels have been modestly up, but the coming development of unconventional gas will lead to an increase and redeployment of capital expenditures. China's deployed troops to South Sudan to protect oil field assets and personnel amid the rebellion there, which supplies about 2% of China's crude imports. During 2014, Asia's EPCs and shipyards saw significant contracts being awarded to the region due to increased confidence in their ability to deliver quality services, particularly Korea. A majority of these contracts are in FEED or construction phases. Consequently, we've seen an increase in demand for skilled project engineers and construction professionals. And then moving right down to the southwest of the world, we move to Australia. Australia has 60 million tonnes per annum of additional LNG capacity coming online and is poised to become the world's largest LNG producing nation. Incidentally, most of the projects there have seen severe cost overruns and delays, and the consequence of that, consequently, the underlying economics of the projects are now fairly questionable, and their financial viability will depend on securing high prices from Asian importers who may be lured away by cheaper exports from North America. This has delayed some investments and has put a lid on a lot of the newer LNG projects coming online, and it's shifted attention to improving the economics and the efficiency of the existing operations there. The existing LNG projects are not yet in need of large numbers of skilled professionals in operations and maintenance. However, when this does happen from mid-2015 onwards, a large shift in the industry's workforce will occur as workers with the design and construction skills needed to create facilities are replaced by those required for ongoing operations and maintenance. And so that really, so to summarise, this time last year, our global managing director, John Faraguna, actually indicated that there was the potential that the oil price would fall below $50. So maybe he's to blame. I'm not going to be so bold as to do the same and try and predict the price this time next year. However, I would say that the global economy and the global geopolitical tensions seem to be fairly finely balanced, and it wouldn't take much either way to sway the prices upwards or to see further decreases. So we're definitely at a very interesting time, and 2015's going to be an interesting year. I'm now going to go into a bit more detail around the key findings from the survey, specific to the US and North America. Obviously, as I mentioned before, the survey was run in October, late October, prior to the oil price dropping down to the levels it's at. So some of the findings don't sort of take into account the current sentiment and challenges that we're facing in the industry, particularly around salaries and day rates and that kind of thing. But that said, we do survey people about far more than just salaries and hiring plans, and given that the oil price will recover at some stage in the future, whether that's in the shorter or the longer term, plenty of the findings are still very relevant and topical. And so I hope you'll see that as I talk through them further. First, we're going to take a bit of a closer look at some of the salaries in the US. I'm not going to spend too much time on this. You can see here that the average salary was around $119,000 in the US, which is nearly $40,000 above the global average. Local salaries increased by more than twice as much as expat salaries, significantly closing the gap on them from the results we saw in 2013 and bringing them pretty much close to parity. We'll have a look at what may have caused this in a bit more detail later on. And then to look at how this information compared more broadly throughout the Americas, we can see here that there's huge disparity in some countries between expats and local salaries. The US and Canada share the trend that they're very similar, and are very similar in that there is very little difference in salary level between the two, whilst in Mexico, Brazil and Colombia in particular you can see a very significant disparity with expats receiving an uplift of as much as 30%. And I'd say this is more due to a lot of the impact, a lot of the imported expats coming from regions of higher socio-economic wealth. And then, before we go any further, I also thought it would be quite interesting or useful to look at what employers' main concerns were going into 2000 from this year's survey, because I think it's relevant to a lot of the stuff I'm going to talk about in a second. With the exception of 2010, in the wake of the Deep Horizon event, when environmental and health and safety concerns were at the forefront of most CEOs' mind, the skill shortage has been at the main concern for oil and gas business leaders, and it continues to be in 2015, despite concerns over the economic outlook, which obviously were pretty well-placed concerns. So we wanted to look at, in a little more detail, at how people saw the skill shortage impacting their business. And so we asked them what they thought the main cause of the skill shortage was, and the results for the US were that poor knowledge transfer, a loss of manpower, and presumably due to the pending retirement bubble there, and a lack of fresh talent entering the industry, rank as the top 3 issues that's contributing to the skills shortage. We always like to have a look at the mobility of the global workforce, and that's one of the key things that I think comes out of this guide. And what I mean by that, in essence, I'm talking about where people are travelling to and from for opportunities. We've also combined this year with some statistics around what actually drives their decision-making when they're looking at opportunities, how they're actually looking for jobs, and in turn how employers are trying to find them. So firstly, we'll look at how much we use imported talent in the US, and you can see here that companies in North America as a whole have a smaller percentage of their employees that are expat workers, and way below the global average, with only 20% of respondents being expats in the US and 30% in Canada. You can also see there that there's a 3-year declining trend across North America, and a bit of a dip worldwide. And there's possibly a few factors at play here. Globally, I think there's been a ramp down in major project work, particularly in Australia, where a lot of the major LNG projects that have been underway are all reaching completion or nearing completion. More locally, there are far greater immigration barriers to bringing talent into both Canada and the US, and that makes it a lot harder and less desirable way to go about sourcing candidates. And I also think that the market has been far more heavily focused on non-conventional plays, which means there's less available talent with the right sort of experience around the world to import. So we'll see. It'll be interesting to see how that changes over the year and to look back on it at this time next year. And so where do we actually get talent from in the US? So what countries do we go to most to find expats? Interestingly, India's in #1 spot with 14%. In joint second spot are the UK and Venezuela with 7%. In 4th position is Mexico with 6%. And in 5th spot is Nigeria with 5%. So this year, 60% of companies were expecting a significant decrease in their expat workforce, whilst 20% expected an increase. We've seen for the past 3 years that India, Venezuela and UK have been the biggest source of expats, and clearly this year is no different. But that said, there's been a dramatic increase in the amount of talent coming from Asia, and you can see that Mexico is now nearly as big a source as the UK. Coming back to the narrowing of the gap between the expat and the local salary levels in the US that I talked about just now, I think this is this trend of a higher percentage of expat talent coming from lower socioeconomic regions is probably the key contributing factor here. And so let's look at the reverse and see where Americans travel to for opportunities. So the top 5 are Saudi Arabia with 10%, the UAE with 7%, the UK is next with 5%. Actually, Iraq is equal as 5%, and then you've got your northern neighbours, Canada, with 4%. The remaining 67% are scattered far and wide. I don't think there's really any surprise that the Middle East remains the top location because it's an opportunity to go and earn tax-free income. But the survey certainly did indicate that South America, particularly Brazil and Mexico and Africa, had the greatest increases this year, just missing out on the top 5 locations. And companies in those regions seeking US engineers and geosciences specialists with deep water and subsea experience, as they have projects going on requiring niche skill sets similar to those developed on projects in the Gulf of Mexico. Interestingly, the US had the lowest percentage of talent working on international projects when compared to other regions, particularly Europe and Asia, where that figure is closer to 40% of their talent working on expat assignment. I think a major contributing factor to this is probably the reciprocal tax laws that make US citizens more expensive and therefore less attractive as potential expats, along with the Foreign Account Tax Compliance Act, which is actually causing a huge amount of expat Americans to resign their US citizenship. And amazingly, quarter on quarter, Q4 of last year saw this number increase 39%. On the whole, I think the fact that fewer Americans do travel for work is a good thing for the industry locally, because it means you lose far less of your homegrown talent to other markets. And so then we also this year wanted to spend a bit more time drilling down further into what guides an oil and gas job seekers' decision-making process when they're looking at opportunities. So we asked them exactly that, and the results of all the respondents around the world were as follows. So in first position, 95%, and no surprises here, 95% of respondents said that the salary level was the #1 driver. But in a very, very close second spot, and there's only 3% in this, so essentially it's equally as important, was company reputation. And anecdotally, we've seen this becoming more and more important for candidates in all industries around the world. Third was benefits with 88%, and then again in a very close fourth position is career progression, and again we're seeing this becoming more and more important to employees, no matter what industry they're in, but particularly in the oil and gas industry around the world. Now we also wanted to find out what US employers are doing, that responded to the survey, are doing to be more competitive with their offerings in these areas. And what we saw was that 29% of employers altered their pay structures in 2014 to be more competitive. And this was ahead of the global average of 24%, so clearly doing more there. We've also seen an increasing, but I'd put a word of caution in there, it's still relatively small number of companies putting a lot of time and effort into putting together an employer value proposition and then wrestling with the challenge of how to communicate it to the target market. It's certainly something that many of the larger companies are further down the track on. I'm sure many of you, like me, will have sat in the reception of some of the majors or super majors and seen employee testimonial videos, amongst other things, up on big screens in their receptions, and so more and more companies are starting to look at that as an important thing and how they sell their brand, or how they even define their brand. Nearly 20% more employers have tried to make their benefits packages more competitive. This is another trend that's been increasing year on year over the last 4 or 5 years, and we're going to come on to look at benefits in more detail on a later slide. And then finally, 34% of US employers have made improvements, or respondents, I should say, have made improvements to their training and development programs. Although when we look at this in conjunction with some of the challenges the industry is facing, it might be better to put this that only 34% of companies have done something about this. And again, we'll come on to talk about this a bit more in a second. So we've looked at what job seekers are looking for from their future employers, but we thought of equal interest would actually be how they look for their future employers. I don't think there's any real surprises here to see that using company websites is the highest method used, with nearly 50%. I would make a point on this, though, and given that this is clearly a strong candidate attraction tool for organisations, it's also very important to make sure that your careers section is kept up to date, it's relevant, your latest vacancies are up there, but also you have to think about how people are using the internet these days. We found that more and more job seekers are using mobile technology to look for jobs, yet around only 40% of employers' websites are mobile friendly. We live in a world of convenience, and if you're not making it easy for people to apply for your jobs, then there's a good chance they simply won't bother. So we think that all companies have got to look at that. Next, we have recruitment agencies with nearly 45%. Again, I don't think a huge surprise there, followed closely by job boards and networking with about 30%. Then finally, you can see that 25%, nearly 25%, or just under 25% of job seekers are using social media as a way to look for jobs. I'm going to take a moment here to talk about social media as a digital recruitment tool. So we see here that 22.7% of job seekers use social media to search for jobs, and that almost 70% of oil and gas professionals use social media for personal reasons or uses. Yet when we asked employers whether they currently use social media as an attraction strategy, only 3% of them said they did. And this really is a huge disparity, and one that is only going to grow. Social media is becoming a bigger and bigger part of everybody's lives. As a global recruitment firm, we're seeing social media being used more and more by job seekers and employers, and it is a fantastic way to engage both active and possibly more importantly passive job seekers. It presents a great channel to communicate your EVP through to a captive audience and to get your message heard. By way of example, I'm going to do a little bit of self-indulgence here. And at Hayes, we've invested a huge amount of time and money in developing our social media following and network. One of the key mediums we focus on is LinkedIn. And the last 4 years or so, we've managed to grow our following from around 300,000 to more than 900,000. And we're now the 21st most followed company on LinkedIn, and we recently overtook some of these well-known brands in that sort of league table. As part of this, we've also developed an oil and gas forum that has around 45,000 members that we're actively engaged with and who communicate with us on a regular basis. And I think a key point to make here is that these people, whether they're just following us on LinkedIn or they're part of our oil and gas forum, have chosen to follow us or chosen to be part of our forum. Now, I'm sure it doesn't sound like it, but I'm not trying to simply show off here. The point is that as a result of this, our followers are 6 times more likely to view a role that we post, and they're 3 times more likely to apply to it. They're also 10 times more likely to refer our content to their network, which gives us a far greater reach to even more engaged candidates that are likely to be interested in potentially your job. I'd also argue that being referred by one professional to another professional is one of the most powerful ways to do recruitment. So there's a couple of messages here. One is to choose your recruitment partner wisely, and I'm a little bit tongue-in-cheek there, but also serious. But the other is that the recruitment landscape is changing rapidly, and to be effective, companies need to be developing their recruitment strategy to ensure they're visible to their target market, and their target market is increasingly using social media to do recruitment or to look for jobs, and it needs to be a major part of your armory. Coming on now to look at some of the other recruitment challenges people are facing and around retention. Coming on to and to look at benefits. So we saw earlier that benefits is very important to employees, obviously. So we asked whether people are receiving benefits and what sorts of benefits they receive. So some really good news for US oil and gas employees here. We saw that in 2014, so nearly a 20% increase in the number of companies offering benefits, with 78% of respondents to our survey now receiving them, which is around 5% more than the global average. This really shows that companies clearly see it as a strategic importance to offer a strong benefits package, and it's a good method of retention. Not surprisingly, health plans are the most offered benefits in the US, with bonuses coming in second. We see bonuses as a very effective retention and attraction tool, particularly if they're performance-based. We experience it being very hard to facilitate candidates leaving one job to go to another when there's significant bonuses on offer at certain times of the year, and it can be a real thorn in the side of hiring managers. You can also see there that more than a quarter of employees receive training now receive training as part of their benefits package. Again, you could argue that only a quarter receive training as part of their package. I think it's a surprisingly low number, personally. So because we're in our 5th year of conducting the survey, we've been asking a lot of the same questions year on year. We can now look at historic changes and trends in the benefits packages, and these numbers listed here are global averages. They're not specific to North America. You can see that all areas have been increasing year on year. Bonuses really have leveled out in the last few years, but all the others have seen major increases from 2013 to 2014. Training's received the biggest year on year, which I'm very pleased to see, and received an increase of more than 50% in 2014, with now over 21% of companies offering some sort of training and development. I think that's really important when we bear in mind that the skills shortage is the biggest concern for companies. And we're nearing the end now, so lastly we're going to look at the demographics challenges and the question of whether the gap is being bridged. These are two topics of hot discussion. The gender gap in the industry has been a big concern for employers over the years, and we've been involved in major global campaigns for companies in an attempt to try and understand the gender gap in particular and how to attract more women into the market. Sadly, really on a global level there's been little change there. And there's also a well-publicised concern over the ageing workforce that is progressing towards retirement age, and a relative lack of entrance into the industry. So let's take a look more closely at this. So gender first, and I think what we see here is actually a pretty encouraging looking graph. Globally, there's a slight increase over the last few years, but really it's relatively negligible. But for the US, you can see that there's been some significant increases. To be clear here, this is 21% of respondents to our survey were female, which is 82% more than the global average. I fully appreciate this doesn't necessarily mean 21% of the workforce is female, but it's definitely a very positive trend, and the US is clearly achieving some outcomes here that the rest of the world is failing to. The highest percentage of women are in services, but you can see there's a good spread across disciplines. 90% of them are in permanent roles versus 75% of male workers being employed in permanent roles. And I'd suggest that's probably because they're earlier in their careers in the industry and therefore less likely to be on contract. And then moving on to look at the age demographics. So the pending retirement bubble is clearly demonstrated in this slide. Again, we've been tracking age demographics every year that we've run the survey. Obviously, given the size of the sample of data that we get, we can get some variations to the results, but typically we see something very, very similar to this. First is what actually looks like a pretty healthy spread globally. The US has a very pronounced problem. This year, 47% of our US respondents were aged 50 or over, while 19% are Gen Y. So the deep technical knowledge and expertise that sits with the baby boomers. So there's really a 5 to 15-year window to try and transfer this knowledge and replace the talent that will be departing the industry. It's a pretty complex problem. The current market conditions add an additional issue. I don't necessarily think to do with the loss of existing talent, as I don't really think companies are going to consider losing their top talent, as they simply can't afford to. But another deep downward cycle, so close to the last one, could make the attraction of fresh talent into the market, or into the industry, I should say, even harder. Whilst there's plenty of other technologies-based industries that are becoming more attractive, and on top of that, the US economy is now in an upswing, meaning in general there are more opportunities available to new people looking to enter the market or graduates coming out of universities, whereas in 2010, when the market started the upswing, the US economy was in a very flat growth phase. So it's a far more attractive proposition for people. Certainly, companies need to be spending a lot of time developing robust succession plans that include comprehensive training and development programs in line with the needs of their businesses, and they need to be thinking about how they're going to attract increasing volumes of fresh talent and what mediums they're going to be trying to engage with that talent through. So I'm going to very briefly look at the hiring trends and outlook that was prior to the pre-oil price fall, and I think this is one of the things that's potentially changed the most. But looking back to October, employers were optimistic about the market conditions. There were only 60% of them had plans to increase headcount, and I think this demonstrates a degree of caution about the market, and it was clearly well-placed caution. How much of an impact the oil price we'll see, and we'll look back in interest at the end of the year, and then a brief look at the contractor workforce. So there's been a declining trend in the use of contractors over the last 3 or 4 years. Indeed, only about 24% of our respondents were contractors in the US. Last year saw an 18% decline in the use of contractors in North America. But 20% of US employers are or were expecting to see an increase in the use of contractors. I guess we'll see how this plays out. We've already seen huge volumes of contract workers let go as a response to the oil price, especially in the oil field services space. But once we see the oil price settle a bit more, there's probably a good chance that we could see companies using more contractors where they have a need to deliver on an increase in workload but don't want to commit to a permanent headcount. It could also be a good way to bridge the gap between the loss of knowledge and retirees that companies are facing by getting older people back into the workforce in a training and mentoring capacity. And then finally, just to really look at summarise the key findings. So more employers are offering benefits than ever before, and health plans are on the rise, which is an excellent thing for employees. Contractor numbers have shown a slight decline as employers offer permanent hiring. After salary, and I'd say almost equal with salary, company reputation is the main deciding factor when oil and gas professionals are considering a new job. The skills shortages are the #1 employer concern, and they blame skills shortages on the lack of knowledge transfer and poor succession planning. Our recommendations: firstly, you've got to act now to prepare for the baby boomer retirement. One of the pitfalls will be delaying plans whilst waiting for the oil price to recover. If that takes 2 years, fair enough, your business activity can go on hold, but that doesn't mean your baby boomers are going to stop aging for that 2 years as well, so they get close to retirement no matter what happens. So you need to be targeting Gen Y to help alleviate the skills gap, and look to attract ambitious Gen Y by showcasing your organisation's succession plans, the training and development programs, and why they can have a great career with you. Social media has to be at the forefront of your plans to both promote your employer brand and to seek new employees. You need to be thinking about partnering Gen Y with the baby boomers to reduce the impact of the transfer of the knowledge loss, and then look to attract talent back to the US with a strong employer brand as well. And that really ends the presentation. I hope that you found it of use. I'm completely open to taking any questions that there are and that I can. We often get asked here, how can we get a copy of the guide? And the answer to that is that one of our consultants will be in touch over the next few days to organise for a copy to be delivered to you. And we're going to be putting this presentation online, so you can go back and view it. It'll be on our website, hayes-oilgas.com, later on today. So I'll just wait a couple of minutes to see if there's any questions. So I've got one question come through here. So do you think employers are really becoming more concerned with having an employer brand and how they promote it to the market? And the answer to that question is that yes, we are definitely seeing companies becoming more concerned with it. Larger organizations, I suggest a lot of the bigger operators, EPCs, oilfield services companies have done a lot of work on this over the years, and it's a big part of their recruitment plan. Smaller organizations, the SMEs, are recognizing it as a bigger and bigger issue. The challenge with them being, like, how do you put the employer brand together, and then what do you do with it? And then what do you do with it once you've worked out what it is? And the challenge of reaching your target market is, how do you navigate the various digital recruitment channels there are? There's social media, you have Facebook and LinkedIn and Twitter and so on and so forth, and how do you actually get people to engage with you and to make those channels useful? So that's the real challenge around it. So that's the answer I'd say, and we would be happy to come and talk to anyone about that in more detail, because it's something that we feel we've built up a lot of expertise in over the last few years. That's it. Doesn't appear to be any other questions, so I'm going to leave it there. I'm going to sign off. Thank you very much for tuning in and listening. Sorry about the delay at the beginning, and have a great day. Thank you very much.